Stocks are dropping right after the Federal Reserve cut interest rate. That doesn't make sense, right?
What?
So what's actually happening, and does this kill the Santa Claus Rally? Let's talk about it. Hey YouTube, Julian here. The Federal Reserve just cut interest rates, and instead of markets going up, stocks are dropping. Tech is selling off and sentiment looks shaky. And traders everywhere are asking, is the Santa Claus Rally cancelled? Today, I'll be breaking down exactly why the market is selling off, what's really driving this move behind the scenes, and how you should actually think about this environment as an investor. Let's dive right in.
Now, if you like videos like this, I'm going to give you 5 seconds. Help me out by clicking subscribe and also commenting more so that I can produce more videos like this for you guys. 5, 4, 3, 2, 1. Without further ado, let's get back into the video.
So if you missed the news, the long-awaited FOMC meeting happened on December 10th, with the Federal Reserve cutting interest rates by 25 basis points. Naturally, people would be expecting one thing: markets to rally immediately.
To infinity and beyond!
However, the markets had other ideas. Instead of ripping higher, SPY ended the week in red. And when you look closely under the hood, this was clearly a tech-led sell-off. Nvidia closed the week down 4.05%, Broadcom down 7.77%, Google down 3.73%, Meta down 4.33%, and Oracle led the sell-off down 12.69%. So the obvious question is this: why is this happening? First, let us clear the confusion. Most people think that the markets rally immediately after the Federal Reserve cut interest rates. This is not true. I actually broke this down with a historical data in my previous video, and I will put the link in the cards if you want to check it out later, so you can see for yourself what really actually happens after the rate cuts. But here's the key idea that I need you guys to understand for today. Tech cracked before the rate cut. Now, this part is important.
Tech sell-off.
The tech sell-off, major sell-off.
Sell-off in tech stocks.
The tech sell-off didn't start because of the rate cut. It started even before the rate cut. Big tech and AI names sold off on weaker earnings, cautious guidance, margin pressure from heavy AI spending. And that already damaged the sentiment and started the pullback. So by the time we got to the FOMC meeting, the market was already on shaky footing. Number 2, markets went into the Fed meeting weak. Going to the rate cut, tech was already under pressure, indices were rolling over, positioning was cautious, not aggressive. So the market wasn't exactly asking, will the Fed cut interest rates? It was actually asking, will the Fed change the narrative and reverse what's already happening? Number 3, the rate cuts didn't reverse the trend. Here's the nuance. Yes, the Federal Reserve did cut interest rates, and yes, they did signal that there was one more possible cut that would happen if inflation continues to cool and the data allows it. But that's the keyword, if. They did not signal a full easing cycle. In the official statement, here's what the Federal Reserve said.
The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks.
So what does this mean? It means maybe one more cut in the next year. Not guaranteed, fully data dependent. And this wasn't a unanimous decision. 3 officials, Austin Goolbe, Jeffrey Smith, and Beth Hammack, actually voted against the rate cut because inflation was still above the Fed's 2% target and they wanted more data before easing policy. So from this market's point of view, it wasn't a very confident bullish pivot. However, it was a more cautious move with internal disagreement. The rate cut didn't create a new bullish trend. It actually failed to stop the one that was already in motion. That's why price simply continued lower. So, does this kill the Santa Claus Rally? Historically, the answer is not necessarily. The Santa Claus Rally refers to the last 5 trading days of December and the first 2 trading days of January, where the markets tend to drift higher about 70 to 75% of the time. But this is not magic. It's mechanics plus psychology. Why does this happen? First up, trading volume drops over the holidays. This means that institutional investors oftentimes step back during the holidays, leaving the markets dominated by retail traders and smaller participants. And lower trading volumes can result in less resistance to price movements. Next, there are going to be small buy flows which move prices even more. Most professionals tend to receive year-end bonuses or make final contributions to retirement accounts during this period. And some of this money flows into the market, adding small buying pressure. And this effect is particularly noticeable in December because investors will tend to seek out advantage of market movements before the year wraps up. And lastly, sentiment improves. Now you see, holiday season often brings about a wave of positive sentiment. Everyone is excited for the new year. And this optimism can also influence traders to take a bullish stance, especially as many are eager to start the new year on a strong note. So all this accumulates and creates a structural upward bias into the year end. However, instead of just talking about this in theory, let's actually look at the facts and the data. I'm going to be walking you through the charts, showing you exactly what happened during this Santa Claus window for the last 10 years to see if there is really a rally or not, and also if there is, how strong is the rally. This isn't about predicting this year perfectly. It's about helping you understand the probabilities and the behaviors. So let's hop onto the charts. So let's start out with 2015, and as you can see right here, 2015 did not show a rally. Instead, price started out here and ended right around here. So when price comes down, I consider this as not a rally. So did it rally? The movement was about 4.45% down. Now let's look at 2016. Price started off here, price ended off over here, and you can see that it did do a dip before pushing up. Now, if you count the portion where the dip happened and you consider this as a rally, yeah, sure, I will count this from the bottom right here all the way to the highest point. It actually went up about 1.74%. Now, is there a rally? Yeah, you can consider that. And is there a movement? Yes, there was 1.8% movement because I kind of missed out this bottom portion by a little bit. Now, moving on to 2017, this is a clear rally. You can see price started off here, ended off around here. So rally, yes, movement is about 1.4%. Next, let's look at 2018. Price started off right here. Price ended up here. So yes, there was a rally. The movement was about 7.4% from the lowest all the way to the highest point. Next, 2019, was there a rally? Price started out over here. Price ended up here. So yes, there was actually a rally. The movement, I count it from the bottom all the way until the highest point, 1.4%. Next, let's look at 2020. You can see that price started out over here. Price ended around here. So this was indeed a rally, although it was also quite sideways because there was one day alone. This candle right here shows that it punched all the way down and went back up again. So yeah, I would say kind of rally. So if you count it from this point onwards all the way until the highest point over here, I would say that price moved around 2.2%. If you want to count it from way bottom here, I would say it's going to be slightly more than 2.2%. Now, if you look at 2021, yes, I would consider this as a rally. Price started off here, open here, price closed around here. So yes, there was a rally, even though it was a bit sideways. The movement from the lowest point all the way until the highest point was about 1.65%. Now, moving on to 2022, price started here, price closed around here. So actually, there was no rally. This was more sideways movement than not. So the movement was about 2.54 from the lowest point all the way to the highest point. Next, let's look at 2023. Price started off here, price closed down here. So this was not a rally in 2023. So this one, the highest point was on top here and price went down about 2.1%. Next, 2024, you can see price started out here, price ended here. So this was a dip of about 3.61%, and no, it is not a rally. So altogether, if you look at the total 10 years combined, you can see these are the summary of whether there was a rally or whether there wasn't a rally, and the chances for a Santa rally happening would be 6 out of 10. Now, instead of stressing out over whether we get a Santa Claus rally or not, I want you guys to zoom out. If you are a long-term investor, you don't get paid for predicting short-term moves. You get paid for owning good companies at good prices. the markets will continue to shake you emotionally. Headlines will flip left and right. Seasonal narratives come and go. But when you have quality stocks that pull back because of fear, that is not a warning. This is opportunity. So if we rally, great. If we dip instead, that's probably your Christmas sale. So I want you guys to think about this way. Focus on quality. Be patient and let time do the heavy lifting. Now, with that said, let's have a look at the S&P 500 on the charts to see where it's going next. So as you can see, this is the S&P 500 or SPY. Right after FOMC, there was a moment that S&P 500 was trying to break out of the all-time high. However, it wasn't able to. Then the next day, what happened was that because of the AI and tech crash, as we mentioned earlier, it actually turned out that Friday became bearish, and therefore SPY is right now heading towards the support back again. When it's at the support, it needs to decide on what it wants to do, whether it's going to respect it, continue its way up again, or break below and continue its way down. So this is what I see for the S&P 500. In order for it to go up higher, it has to break above this level of resistance right here. Failure to do so, as what you saw happen, is going down. Apple has had a breakthrough previously before the FOMC, and what happened is that it didn't have much of a news or much movement after the FOMC news. In fact, it was just mainly playing sideways. If you ask me, this seems to be a slight pullback, and right after, I would assume that if Apple does have enough buying power, it will actually be pushed up towards reaching back to this level again. So let's see what happens to Apple. Next, let's look at Google. Google also did have a slight pullback as mentioned from my previous video last week. If you haven't checked that out where I talk about quantitative easing, please go and do so. Watch that video. Right here, you can see that this is the pullback that I was mentioning about. And right now, it needs to respect this support. If it does respect the support, likely is that it has a chance to go up. If it doesn't, it will go down to the next area of support right here. Next, let's look at Microsoft. Microsoft has also been playing sideways, going up and down within this level of support and resistance. Right now, it's probably heading towards the it's like kind of in the middle if you ask me, but if it does respect this support, it will likely go up to the resistance back again, and it has to get enough buying power in order to be pushed up and go on into higher highs. Next, let's look at Tesla. Tesla seems to be in a good spot. After the previous rally, you can see right here that price pushed up to this resistance. Right now, it's deciding on what it's going to do. If it wants to break above, it needs to close above this level of resistance for it to be able to go up higher. Failure to do so, it will actually go down. And right now, one of the catalysts for Tesla is actually the news of SpaceX, which is likely going to go for IPO in 2026. So that's the reason I would say that people are feeling a little bit more bullish for Tesla. Next, let's look at Amazon. Amazon has also had a terrible Friday, closing off slightly bearish. Right now, it's trying to decide on what's going to happen, but it seems like it's heading down to this next level of support right here. And usually during the holiday season, Amazon, right, being one of the popular e-commerce brands, would normally be having a pretty good holiday season, but it doesn't seem like it's doing too well right now. So let's see what's going to happen to Amazon. Really, if it wants to go up, it just needs to break past this resistance in order to continue its way higher, which is what it tried to do. Failure to break this resistance, let it come back down again, and therefore playing sideways until it has enough buying power to go up. Next, let's look at Nvidia, which is also one of the leading factors that caused the tech crash. As you can see, Nvidia closed pretty bearish on Friday. In fact, it actually closed down right about, let's see, 4%, right, on Friday, which is not a good sign because Nvidia also represents a majority of the S&P 500. So when Nvidia goes down, the S&P 500 will go down together as well. So right here, you can see that in one day alone, it actually went from the resistance back down to the support. So we need to hope that Nvidia will be able to push back up again. And this is actually pretty interesting since Nvidia did have some good news, I would say, right? When the US actually allowed expansion of production of the H200 AI chips over to China. However, that didn't seem like it was enough news to keep investors happy. Therefore, Nvidia actually plunged down. Next, let's look at Meta. Meta was also having a great push to the upside on Friday, and look what happened. Within a span of one day, it actually went down about 9.8%, almost 10%, right? Which is pretty insane for Meta standards, I would say, right? So this big movement or this big push right here, again, one of the reasons why the S&P 500 dropped. Okay, so right here we can actually see that gold did have a push up after the FOMC news, and gold is still respecting this level of support as I mentioned before in my previous video, and therefore you can see that the FOMC news gave it a huge push within the last 4 days all the way up. However, it didn't actually manage to close above this resistance just yet. However, if you look at it from the weekly perspective, you will be able to see that weekly candle has already closed above this level of resistance right here. So I would say that this is a good sign that gold still wants to continue its movement up. Right now, I'm expecting a short pullback, but after this pullback, it's going to continue pushing upwards. And usually in December, there's always going to be a rally, especially for gold. If you actually see the history for the past few years, every December is mostly bullish for gold. So if that trend still continues, likely we will actually be looking at having all-time highs for gold coming again really, really soon. So this is what we need to see. We need to see a candle break above this level here on the daily perspective for it to continue its way up. And I would say that this may happen sooner than you think. Next, I want to look at the macro perspective of Bitcoin. As you can see, Bitcoin is still struggling to make movements up, even though recent news is that Michael Saylor did mention that they actually invested 1 billion over into Bitcoin. However, this doesn't seem to move Bitcoin that much. You can see even though after FOMC news, which was supposed to be good for growth companies, growth stocks, crypto, and even gold, it didn't really affect Bitcoin that much because Bitcoin is still playing from within the sideways perspective. So this tells me one thing: even though with Michael Saylor injecting in 1 billion into Bitcoin, it wasn't enough to move the markets up because the sellers are still stronger than the buyers, or at least I would say they are equal, very much equal. That's the reason why it didn't really move as much. For Bitcoin to continue higher, it has to break past this level of resistance right here in order to show signs that it wants to continue going up. Right now, it still hasn't showed that. Although if you notice in the daily perspective, it still shows signs of bullish pressure, as you can see right here, still respecting, creating higher lows and higher highs, which is a good thing. I would say not so much a higher high right here because this still close below, but I want to see a bigger push to the upside in order for Bitcoin to continue flying higher. So with that said, guys, thank you so much for watching this week's market outlook. I hope that you had a clearer perspective about the Santa Claus Rally and what's happening after the Federal Reserve actually cuts the interest rates and why markets didn't actually go up. Now, if this was helpful for you, help me out, click on the subscribe and also like button so that this video gets more views and this gets to help more people as well. Now, if you want to also see how I was able to get $82 into $10,000, I'm going to put a link to the video right around here. Watch it and I hope to see you in the next video. Bye-bye.